Hello, I'm Peter Herbert from Insight Training, and welcome to this latest in our series of short CPD training videos, which this month is going to look at changes to audit ethics. The FRC ethical standard was substantively changed back in 2016 and again in 2019, and there are further changes coming down the line effective from December 24. And what this session is going to do today is look at the key changes and the way they'll impact on audit ethics for independent firms. So there it is. The revised definitive standard was published in January of 24, effective, as I say, from 15 December 24. The exposure draft or consultation draft published in August 23 pretty much reflected the final rules in the revised standard. There were one or two areas where there was a slight dampening down of the sort of suggested proposals. But fundamentally, in terms of the way that this revision will impact on independent firms, there's kind of four areas I want to focus on: the removal of the concept of the EP, some rules in relation to the 10% and 15% thresholds for fee dependency, guidance around tax services to individuals, the majority owners of unlisted entities which the firm audits, and further guidance on prohibited IT services. Let's look at those one by one. Okay, now the concept of the EP, the concept of the other entity of public interest, is not one that we come across that regularly in practice. It's been around for a few years now. And what we're fundamentally saying with these sorts of organizations is they generally tend to be, certainly in terms of the private company arena, really big private companies. They're not defined as public interest entities, but because they are defined as an other entity of public interest, the ethical rules that apply to public interest entities pretty much apply to them as well, especially around things like prohibited services. Now, the key one I want to focus on here is the one in the bottom right-hand corner of this slide. So entities that are subject to the governance requirements of the Companies Miscellaneous Reporting Regulations 2018 by reference to the most recent set of audited accounts. As I say, these are really, really large private companies. And what that particular statutory instrument talks about is an entity which has got more than 2,000 employees and or has got more than 200 million turnover, and in addition, more than 2 billion gross assets. So when you're that big, you're an EP. Now, what's changing? Well, what the FRC are looking to do here is to remove the concept of the EP. And this ties into an aspiration to actually redefine what we mean by a public interest entity. And in doing that, that will render the FRC feel the concept of the other entity of public interest kind of irrelevant as far as audit ethics is concerned. Now, redefining what we mean by a PI, a public interest entity, that will require legislation. And what the FRC is saying is, we can't really remove the concept of the EP until legislation has been passed to redefine public interest entity. And therefore, with that one, it's going to happen, but it's kind of a watch this space. And for the avoidance of doubt, what they're aspiring to do is to redefine public interest entity in such a way that it will be any entity, including a private company, which basically breaches what we tend to refer to as the 750 plus 750 threshold. So more than 750 million turnover and more than 750 employees. And that will certainly bring more really big private companies, really big charities into scope. So that's the idea there. Watch this space. When PI is redefined, EP drops out. I still think for a lot of the people we speak to day to day, I suppose in slightly smaller independent firms, I don't really feel that's going to have a massive bearing in terms of the way the audit ethics would apply. Okay, the second one I want to look at is the change in the rules around the 10% and 15% thresholds. This affects a small number of firms, but it's probably more common than you'd think. The way this works, you may recall, is if you're thinking about a situation where maybe a single client, in terms of the fee income you generate from that client, recurring fee income that your practice generates from that client, where that recurring fee income amounts to more than 15% of your practice income, so significant is the dependency on that client that you couldn't then act as auditor. In terms of the 10% threshold, when a particular client provides between 10 and 15% of your recurring practice income in terms of the goods and services you provide to that particular client, you can act, but that particular audit does need to be subject to an annual hot file review. So yeah, these are reasonably uncommon situations. I've certainly over the years done a number of hot file reviews for firms where they have got in that situation where that 10% threshold has indeed been breached. Now, what's changing here is they're saying that in doing the calculation about whether you breach the 10% or 15% threshold, you've got to take into account fee income generated from companies under the common control of the owners of the company in question. I think the idea here is that probably in reality, that should always have been a consideration, but it's not technically been a consideration. No, it now will have to be. And I've met at least 2 practitioners over the last 6 months that have said they've got scenarios whereby taking into account fee income generated from common control companies will indeed push them over that 30% threshold. And as a result, they're going to need to let the audit go. So quite a niche point, very front and center though as far as independent firms are concerned. And again, in terms of these changes, one we do need to make you aware of at this time. Okay, the third one. Now this is really just sort of, I suppose, application guidance in terms of saying when you're thinking about the threats to independence in relation to tax services, you've got to take account of services that you provide as an auditor, audit firm, to owners of unlisted entities which you do the audit for. And I guess for many firms, the services provided to the proprietors will typically involve doing the director's personal tax returns. Now, here's a scenario. Okay, the auditor of an entity provides routine tax compliance services to a client's controlling shareholder. Let's say that will include personal tax returns. Will that in any way, shape, or form impinge on the objectivity of the firm in terms of doing the audit? I would think very unlikely. And I think this is not going to be a massively big deal insofar as you've got to think about the sort of services you provide, take a step back and think, right, might that in any way, shape, or form impact on objectivity? If so, we've got to do something about it. If not, not a problem. And of course, in terms of these sort of services, invariably, it will be a different member of the wider team providing these services, not in any way, shape, or form associated with the audit. The second sentence, though, I think there is interesting. In addition, the auditor has been recently asked to value their shareholding for tax purposes. Now, that I suppose is something that you might find that you're asked to do for a proprietor of an audit client. That, I guess, could create some issues. Let's say, for example, that share valuation is being done for the purpose of maybe transferring some shares to a family trust. And I guess the question there would be, how is that valuation being done? Is it maybe being done on a multiple of EBITDA? Does that require sort of cash flow projections to be prepared? Are they perhaps in some way, shape, or form being prepared by the auditor or by the audit firm? And might those same cash flow forecasts then be relied on down the line by the audit team for the purpose of the going concern review? So don't rule out tax services provided to proprietors creating an issue. As I say, I think if it's just generally ordinary cordon garden compliance services in the form of the personal tax returns, less likely to be an issue, but do think about other things you're doing around the edges there. Again, I think a lot of us feel this should always have been a consideration, but certainly it's very much there now on the list of things to think about. And going forward, that will obviously be an important thing to do. Okay, the final aspect involves prohibited IT services. And what I want to do with this, if I could, is just roll back a little bit to a change brought in the 2019 iteration of the standard, which I think has created quite a few ructions in the last year or so, and just sort of talk through that, and then off the back of that, explain what's changing now with the 2024 revision. Now, here's the scenario I wanted to just talk through. It's one that a firm that we do quite a lot of work with shared with me probably middle of last year. And this was therefore very much based on the current version of the ethical standard rather than the revised version coming in from December 24. Your firm has recently helped an audit client implement client computing software, creation of chart of accounts, transfer of data, etc. Is this allowed under the ethical standard? And if not, what are the implications? Now, what was actually occurring here was this particular firm was kind of introducing clients to Xero. And I suppose a lot of firms do, introduce clients to particular packages. But this was very much a sort of a key area of work for this particular firm. And what cropped up in conversation was that there might be an issue here in terms of the firm providing this service generally under the 2019 revision of the ethical standard. Now, here's the relevant paragraph. It's paragraph 5.50 in the 2019 version. It's paragraph 5.52 in the revised version. The firm shall not design, provide, or implement information technology systems for an entity relevant to an engagement where the systems concerned would be important to any significant part of the accounting or financial management system. So the question I suppose with that one is, does that give us a problem in terms of Xero introduction? Well, looking at those three aspects, if you're introducing a client to Xero, you aren't in any way, shape or form designing an IT system, I wouldn't say. I would also argue that you're not providing the IT system because I suppose fundamentally that's being provided by Xero. You're quite simply the conduit to get the client on board with that particular system. Are you actually getting involved though in implementation? And the example talks about creation of chart of accounts, transfer of data, etc. That's the one I think you've got to be really careful about. Now, I'm not sure that when they made this revision to the ethics standard back in 2019, this was the sort of situation they were really trying to address. But if you were doing any element of adaptation of the standard Xero proposition for clients, you've got to be really careful then that you're not, getting into implementation. But let's be really clear on this. It's not all three of, it's any one of design, provide, or implement. And I've done lots about this on courses recently, and lots of practitioners that do audits absolutely take the view that under the ethical standard, this is very much a no-no where the client is an audit client. So that's just worth bearing in mind. Do think about that very carefully. Many of the issues that we face when applying the ethical standard are issues that you can mitigate by putting an appropriate safeguard in place. But in areas like this, it's actually a clear red line. These are services that you absolutely cannot provide. Now, I talked to that firm again last week on a course, and they were having another conversation with me about situations where maybe we're doing Xero implementation for a client that's not currently an audit client, but that is growing and will soon become one. And again, with that in mind, I think it's important to take a fairly cautious approach here. Now, there's no hard and fast rules, but I do think you've got to think forward. And if you think a client is likely to become an audit client based on increasing sort of numbers, I think in that situation, again, you've got to be very cautious about how you go in terms of the provision of these services. This, I think, was an aspect of the ethical standard that wasn't brilliantly trailed in 2019 when the last substantial revisions took place. It wasn't one that we covered lots on courses. And for that reason, I think we are very much trying to remind people it's there and really get people thinking there about what their approach should be in that situation where the client concerned is indeed an audit client or going to become one. Now, what's changing in terms of the revision for 2024? They're extending that particular prohibition to include storing, managing, or hosting services. Now, that's the list of things you can't do as the auditor, but this storing, managing, or hosting still very much relates to accounting or financial management systems. So again, I think it's important to be mindful of the prohibition there. Think carefully about the services that you are providing. Personally, I don't think the hosting services aspect is hugely impactful, hugely concerning, but the basic premise of the prohibition around the provision of IT services in the first place is food for thought, and do obviously give that careful consideration in your firms. Okay, so those are the four key areas that are changing. The sort of removal of the definition of the EP for reasons we explained. We talked a bit about the 10%, 15% rule. We talked about the provision of tax services to proprietors of audit clients, and we've talked a bit there about IT services and the extension of the prohibition to include hosting services. Before I wrap up, what I want to do, if I could, is just mention one further area, and I call this a bit of an old chestnut, that we do get loads of questions on, which I thought I'd just recap on where we are in terms of our take. So it's all about long association threat. The firm has 4 audit partners. There are several audit engagements where an engagement partner has been involved for more than 10 years. What should they do? Remember the change that came in here a few years ago was to say that prior to, I think it was 2016, you had to think about whether the engagement partner being incumbent for more than 10 years created an independent threat based around familiarity. And if you thought that was the view, you'd need to put a safeguard in place to address it. When they changed the standard back in 2016, the new rule was you will need to put a safeguard in place come what may. And that would typically, I suppose, be, for example, second partner review. I do think it makes auditing really challenging in really small firms where you've got maybe a small number of very, very long-standing clients where you've been, the incumbent for more than 10 years, and perhaps within your firm, there's limited resource available, I suppose, in terms of doing those sort of what you might call second partner reviews. Things to be really clear on. What you've also got to do, this is fairly long-standing now, is talk to those charged with governance and explain to them why you think you should be carrying on beyond 10 years and why that is going to be of benefit to them. And that would need to be a conversation you have at the planning stage of the audit that's documented in the planning paperwork. And from a fire review point of view, we would look at that. We take the view that in terms of that sort of second partner review, as it were, that would need to be a hot file review rather than a cold file review. So that review is completed before the audit signed off, not after the event. Depending on the level of risk associated with the audit, I would say that would not necessarily have to be a hot file review carried out every year. And if that audit perhaps is to do occasional cold file review, that might reveal to you how risky the audit is, and therefore, whether it would be appropriate for that hot review to be done on an annual cycle or a second biannual cycle or a 3-yearly cycle, but it wouldn't necessarily, in our mind, have to be every single year. If you've got a very proficient managers in your office, audit managers in your office, it could be an audit manager that conducts that review, other than an actual engagement partner. So I think very proficient managers with real gravitas and ability to challenge the engagement partner on their judgments, that, to our mind, would work. And a question we got asked recently was, what would you do? What would the rule be if for that very long-standing client, there was then a completely new management team coming on board, and perhaps in your mind, therefore, the people actually running the organization were not individuals in respect of whom you have that sort of a close relationship that might create that problem around familiarity threat. Our take on that would be that you wouldn't kind of, as it were, restart the clock. The reality is you've been incumbent for more than 10 years, and that safeguard, therefore, would genuinely still be required. So a few thoughts from us there around that. That, I would say, is the area that we get most queries on. That's not changing with the 2024 revisions, but that was something I wanted to sort of talk a bit about today, given it is an area we get so many queries on a day-to-day basis, on the reviews that we do, and also on the courses. Okay, so there we are. I hope that was useful. If you've got any questions about the content of this session, please drop us an email at inquiries@insight-training.co.uk. And for our full CPD program for 2024, our website, www.insight-training.co.uk. Hope that was useful. Speak to you all again soon. Thank you.